recent video, I got a comment asking me to explain what I meant by using annual revenue to value a company. So that led me to making this video about the basics about how you may want to value a company. I'll quickly go through the basics of using the price to earnings ratio and then build upon the comment I got on my previous video of using yearly revenue to value growing companies. So what is the price to earnings ratio? It is the price of the stock per share divided by the earnings per share. Now you can also do this by using the market cap, so the total value of the company, and you could use the revenue for the whole year. Both of those would work. When you look things up online, you'll often see it valued as trailing 12 months, so you can use the earnings of the company for the last year. As you start getting more sophisticated, you'd want to look at forward earnings and potentially use your own forward estimate. You really want to look for companies that are going to grow faster than the consensus estimates. Companies that have higher growth rates, that have greater profitability, are going to have higher P/E ratios in general. So if a company is growing the earnings 20% per year, they'll have a higher ratio than if the company is just growing at 10% a year. So if you look at what the price to earnings ratio of the S&P 500 has been over the last 100 plus years, it's not constant. Several factors will drive the price to earnings ratio up and down. Currently, it's at a ratio of 19, or at least for last year. So that means $1 of earnings is going to cost an investor $19. Sometimes you have to pay more to get $1 of earnings, and sometimes you have to pay less. Now we have some anomalies, some spikes. We've got COVID spike. We've got the great financial crisis caused a spike. And then we've got 9/11 and the tech bubble caused some unusual spike. So that's what's going on there. Okay? Typically, you're going to see the ratio somewhere between 15 and 20. Now, one easy way to invest is to just buy the S&P 500. I've done this on many occasions. So an easy way to buy it is VOO. That's a Vanguard ETF. You're going to pay very, very low management fees because they're just buying the 500 biggest companies as picked by S&P. So really S&P is doing the picking and you get their choices for free. So I want to look at what's going to sort of drive these increases and dips. Okay. You have P/E ratios on companies, such as the average P/E of the S&P 500 would be the 500 biggest companies. But competing against how much you want to pay for stocks is what you have to pay for bonds. Okay. And not a lot of people look at the P/E ratio of bonds. Okay. Back in the heart of COVID, when interest rates were super low, you might have to buy a bond if you wanted to and only get maybe 0.5%. Okay. So 0.5% on a bond means if you paid $100 for a bond, you're only getting 50 cents per year. So you can do a price to earnings. Okay. You're paying $100 is the price you pay for the bonds and you're only getting 50 cents. So that leads to a ginormous P/E ratio of 200. So if interest rates are really low, why would you want to buy bonds at P/E ratios of 1/200 if you can pick up stocks at a P/E of 20? So it's going to drive the P/E ratio of stocks up to, but always have the threshold of what bonds are paying. So we're sort of getting around 4% on 2-year treasuries in the US. So a $100 bond, you're going to get $4 a year. So now the P/E ratio in bonds is all the way down to 25. So that's been a colossal change in the last year from a 200 P/E on, roughly on the 2-year US Treasury to now. So this is a big competitor to what you'd want to buying stocks and what you'd want to pay for stocks. If you kind of keep going extreme, not what we have right now, But if rates went all the way up to 10%, so maybe think the 70s or 80s, at a 10% yield on a bond, the PE ratio is only 10. So that's really going to hurt stocks. You're not going to want to pay that 19 times that the S&P 500 is today, almost double to buy $1 of earnings. You can pay, $10 to buy $1 of earnings on a bond. You're not going to pay 20 to do it on stocks, which are typically more risky. So if I flip back to that S&P 500 chart, you see in the late 70s, 80s, when bond rates were really high, the PE ratios on stocks really dropped. Okay. So kind of going forward into this intro, how can you calculate the PE ratio? You just need to take the earnings of a company. So this is coming from Yahoo. You can get the price really easily. And then you just need to find a source that's going to give you the earnings. If you don't want to go through all their financial statements, this is in lots of places. So the previous year earnings for Apple was a little over $6. So if you look backwards or look at the trailing 12 months, the PE ratio for Apple is 24. Okay, so a little bit above what the S&P 500 as a grouping is trading at. We're going to talk about comparing PE ratios to their growth rate. So shortly, we'll take a look at the estimated growth of Apple, which is about 10% for the next 5 years. So I was looking at the trailing 12-month PE ratio. I would suggest as you get more sophisticated, you look at the forward. So you can go to sources like Yahoo Finance and look up analyst consensus forward earnings, or ideally you start building your own models and estimates and really look for companies that you think are going to have a greater forecast than what the analysts are suggesting. That's what's really going to drive a stock up. Years ago, I was invested in Apple. And when they first did their deal with AT&T, they had to amortize out the income they got from their phones. And then eventually they were able to recognize all the income on their income statement right away when they sold phones. So it's kind of, I thought, well documented. It was obvious that the earnings were going to jump, but the market didn't seem to price this in. And that led to a pretty good buying opportunity in Apple when this accounting change happened. My and many people's earning forecasts for Apple were way above what the consensus was. So when you're looking at the PE ratios, there's lots of other factors. This is meant to be an intro video, but one other factor you probably want to look at is the PEG ratio. So the price to earnings divided by how fast that company is going to grow in the future. Now you could use a 1-year growth rate or a 5-year or 10-year. It's kind of up to you how you want to look at that future growth rate. And again, many sources like Yahoo Finance will let you look at analyst consensus. So for Apple, it's trading at 24 times trailing. The 5-year growth rate, just using Yahoo Finance's numbers, is a little under 10. So that gives a PEG ratio of about 2.5. Now, typically you want to buy companies that have PEG ratios between 1 and 2. So the 1 would correspond to, if the PE ratio is 20, it is growing at 20% a year. If the PE ratio is 12, it's growing at 12% a year. So somewhere between that lower bound and sort of not more than double. So if the PE ratio is 15, you're not paying more than 30 times, or a 30 PE ratio. So that's a couple ways or one way to value a stock, the PE ratio, and a few ways to look at it using bond PE ratios to compare against and using the growth rate to compare against. Another way to value companies is to look at their annual revenue and decide, okay, I'm going to pay 1 times or double their yearly revenue, or 5 or 10 times their yearly revenue. You pretty much have to do this with companies that have no profits because they have no earnings to divide by. Now you will see calculations with negative earnings and negative PE ratios. I don't look at them or find them useful. So if you're a young or fast growing company, you're going to look at both that annual revenue, and then you're going to pay a certain multiple of that, and how fast the company is growing is going to radically affect how many times you want to pay. So a slower growing company, maybe you'd pay double or triple the yearly revenue if it's growing, 20, 30, 40%. If something is growing 100, 200, 3%, 300% a year, tripling the revenue every year, maybe you'd want to pay 10 or 20 or 30 times, or in crazy times, maybe you'd pay 50 times. Shopify was trading at 50 times revenue for a while. Now we still have that bond consideration. You're taking a risk by buying a fast-growing company that in the future it's going to have these high revenues, but why take that risk if interest rates are high and you can get a fairly high yield on your money? If you're getting 10%, so $10 in every 100, you're less likely to take this risk out into the future when you can just be grabbing this 10% year after year. So interest rates are going to drive down what you're going to pay for these growth companies. So just looking at a couple examples of how this ratio can change. So this is the price to sales. So that's what I was talking about. How many times yearly revenue are you willing to pay? So this is for Tesla. So this is a company recently that has been growing at 50%. When I say recently, 5+ years. We kind of have this long, consistent, somewhere around 4, 5, 6%. This is back in the days when Tesla still had relatively small revenue. They were growing, but off a very small base. Then the Model 3 came out, and we've had this 50% revenue growth, and that's their forecast now. And they've been trading at a much higher revenue. So 50% growth, and they've been trading somewhere between 10 and 20 times revenue. So again, putting in perspective that if you're trading 20 times revenue, if you're making $1 million a year, you're being valued at 20 million, or 20 times that. Another and sort of last example, if you look at Shopify, for a long time it was growing somewhere between 50 and 100%, and it had a fairly stable multiple. People were paying somewhere around 20 times yearly earnings for Shopify. And then we had COVID hit, things went a little crazy. Both their growth rate went crazy, over 100% at times. Bond prices collapsed. Bond PE ratios are super high, and we saw this sort of 50 times for Shopify for a while. But that didn't last. A few things drove this down that is worth talking about and understanding. First, their growth rate now is down to about 20% over the last couple of quarters, and then there's uncertainty about their growth. So well over 100% at times during the pandemic, down to 20 is a colossal drop. Okay? And then you also have bond yields have risen incredibly from 2020, maybe a PE ratio of 100 in bonds, and now we're at a PE ratio of 25. So both of those have caused Shopify's price to sales to drop. So people aren't even willing to pay what they paid pre-pandemic, call it 20 times. Now it's down around 8, which is still not super cheap, particularly for a company that's only trading at 20 times. I have been an investor in Shopify for a while, so I've sort of rode the ups and the downs. So hopefully that helps you with a bit of intro to valuing companies. It certainly gets really complex. There's so many factors. It's not as simple as you grow at a certain rate and you get a certain multiple. There's lots of different industries, but those are 2 good categories to start, and make sure you're not using the wrong perspective for valuing companies. Now, one big thing I left out is dividends. So I didn't want to touch that in this video, but that's another thing that can really affect what you're paying for a company. So I hope you enjoyed this video. If you did, please consider liking and subscribing.